Profit growth led by all the factors, that is net interest income has risen by over 9%, close to 10%. Our non-interest income has also gone up quite nicely. Fee income is up by around 19%. And also our expenses have come down. Overall operating expenses have gone up only by 2.2%. So this is basically the net result of all of these. That's what's led to the profit growth. And regarding the areas that we will continue to concentrate, retail still looks good. So we'll continue to concentrate on retail. In respect of corporates, at this point of time, people have just begun talking projects. So I don't really think these will materialize in a big hurry. But obviously, as and when they do come on stream, it is an area that we will look at.
Okay. And ma'am, your fresh slippages are also down Q on Q. But going forward, when do you see that the final you will actually see asset quality improving? And as far as the slippages are concerned, which sectors have they come from?
See, slippages again are broadly across all sectors. It's not one sector that is badly impacted, it's all sectors. And slippages coming down totally, I still think, will take another 12 months. Mainly, as we have said time and again, that when the GDP turns, it will take about 6 months. But what we are seeing is that the demand is still not back in the market. So unless and until you see demand come up, demand alone will ensure that your bills start getting paid, your working capital cycles reduce, your receivables getting realized. Once that happens, you will see a much stronger pickup in asset quality, and that is when probably you will also see the slippages coming down.
And one thing you've focused on is cleaning up the balance sheet. We've seen the write-offs above 5,000 crore ever since you've taken over, but right now we've seen even that reducing a bit. Could you throw some light on your write-offs? How much recovery are you seeing there? And do you think more or less cleaning up the balance sheet is done?
No, I think we can still continue to clean up the balance sheet. It's not that we owned, but obviously, for write-offs, you also need to have provision. So you need to have that kind of provision in order to do more write-offs. Earlier, there was one other area that we were doing, that was ARC sales. But currently, ARC sales have come down, mainly on account of the fact of the revised RBI regulations, where they are required to give at least 15% cash upfront. Now, even in the last quarter, where the assets were very good, there are cases where we have realized 100% cash, or even there are assets where we have realized 22% cash upfront. But with this minimum 15%, what is happening is the ARCs are also turning a little wary. The kind of prices that they are giving are way too low for us to accept, and not only that, they are also not forthcoming because they themselves need capitalization, which will take a little time. So therefore, cleaning up of the balance sheet will have to be done through realization or through write-offs. These are the only two ways left to us. So realization is another area where we are giving a lot of emphasis. So we'll see how things pan out, but we are hopeful that we will be able to speed up on the realization front.
As far as restructuring is concerned, this quarter is about 4,000 crore. You're saying going ahead, the pipeline is 3,000 crore. So are you concerned about the fresh slippages also coming from restructured assets? Most banks in this quarter have seen the slippages are coming from recast loans. So what is your sense on that? And going forward, do you think that there could be a last-minute rush on restructuring?
A last-minute rush on restructuring, I am not envisaging. I think most of the accounts that are in trouble are already there. Okay, and in respect of the slippages, the first half year slippage has been in the range of 7.5%. Okay, so that being the case, that goes with the kind of numbers we have seen earlier also of around 15%. So we are not expecting anything more than 15 to 20% guidance that we had given earlier. So we expect slippages will be around that level only.
And lastly, as far as credit and deposit growth is concerned, we've seen 20% growth on your large corporates. So just wanted to sense which sectors has it come from, and going forward, do you see that you will not be able to meet the 15% credit growth target? And deposit growth, how much you see?
See, deposit growth, we are confident 14-15% will not be an issue, but on the credit growth, I think we will be in the range of 11-12% only. We will not be able to reach the 15% target. In respect of the growth that we have seen around 17.5% on the large corporate, this is mainly, on account of projects that are getting completed. So therefore, the exposure is to power, exposure is to iron and steel, or to the metals, not necessarily iron and steel only. So that is where the growth has come from, and again some amount of refinancing that we have done of large loans. That's where the growth has come from.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at ET Now Live. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ET Now.